Hi guys, so let's now have a look at the Asian financial crisis and the lessons that have been learned about exchange rate management as a result of the experiences of the economies of Thailand, Indonesia and South Korea. Okay, those economies back in 97 through to 98 really experienced a massive reverse in economic growth. They went into severe contractions in 1998, and the reverberations of this crisis led to financial contagion, which subsequently led to the Russian financial crisis in 1998. Now, all of those countries were operating a pegged exchange rate regime, and let's have a look at some of the lessons that have really come out of this. So firstly, if developing economies choose to actually liberate their capital account, they've got to make sure that they regulate their financial sector very well, because there will otherwise be a lot of financial fragility. And that simply means that you have an immature financial sector who is not efficient enough, not experienced enough to be able to actually accept lots and lots of money inflows, hot money inflows, short-term capital inflows, and reallocate those resources in an efficient and effective manner. Okay, now this led to all sorts of problems within those Asian economies. It meant that they were borrowing in dollars, borrowing very heavily in dollars, and then lending in local currency. And that meant if the exchange rate peg collapsed, then they would have to pay back those dollars at a much worse exchange rate, of course. Okay, secondly, the investment that was being conducted by that short-term capital inflows really led to an excess capacity by 1997. And as such, the investment, which was initially very profitable and did generate good returns, began to decline quite severely, and the returns available really did drop off, and we can see this point falling marginal rate of return. Okay, so investment is subject to diminishing marginal returns. Yeah, some investment is good, absolutely, but then you get to a point where there is excess capacity, so there's spare capacity in the economy. Now, all of the economies that were so badly affected were all operating pegged exchange rate regimes, and they all tried to defend those pegged exchange rate regimes using their foreign exchange reserves and interest rates, as is typically the case. But all of these attempts ultimately failed, and they helped to actually reiterate to the markets that the pegged exchange rate regime was therefore going to collapse. Now, one of the big problems that was present throughout all of those economies is that in the mid-1990s they had all been running very large current account deficits. Okay, so they run very large current account deficits. Now, if you run a current account deficit, on the other hand, you must run a capital account surplus. We know that they had all of this money flowing into their economies, and that represented their capital account surplus, and hence they had that balance of payments. But the moment investors weren't sure that they were going to get their money back, and then ran for the doors and fled those Asian economies, of course the pegged exchange rate couldn't be maintained because no one wanted to hold any of those currencies. Okay, so as a direct consequence of this current account deficit, that really did help to actually trigger this crisis. But it's really important that you note here that in those Asian economies they were yes, they had a capital account surplus which was generated from short-term capital flows. So if you choose to run a pegged exchange rate and you have these economic fragilities in your economy, you're going to be vulnerable to a financial crisis, just as we see in Argentina right now, where interest rates have been raised to 40%. They have a current account deficit representing an overvalued exchange rate, that their exports aren't competitive, and they also have a budget deficit. So watch this space regarding what happens with Argentina next.